Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
Mr. Sandman,
you get the idea?
bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
and tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
Are you considering investing in gold this year? Well, with the new high that had just hit Friday, perhaps you're thinking about it. It is exciting after all, isn't it? $25.48 an ounce. Oh my gosh. Well, good morning. We're going to be talking about should you be investing in gold today. There are 4 things you need to know if you're thinking about it, so we'll get in that today. Welcome to Protect Your Assets. I'm David Hollander. People around here, they call me the Sandman. And that's because I help you sleep well at night by answering your most troubled tax, legal, financial questions each week. That's because I've been running a tax, legal, and financial firm for over 30 years. And new things just keep happening each week. We're live in the studio. If you have a question, maybe you want to know if you should be investing in something or what you might want to do if something's going on in your family, you can always ask me a question like our listener Jim did this past week about gold. You can email me at questions@pyaradio.com. Again, questions@pyaradio.com. So Jim wanted to know, hey, with gold going up, and in fact, Friday it closed at an all-time high, $25.48. And the momentum when things break new highs is typically higher. And the reason why gold's going up we'll get in today, and what's going on with gold, and what do you need to know about it, and what does the future look like, and how much should you own, and how should you own it. There's so many ways to think about gold if you start to look into it. And there's a lot of ways for you to get fleeced, because there's a lot of people out there who charge commissions that are very expensive, and it's hard to store and so forth. And there's all kinds of things you got to think about it. So we will be discussing gold this morning and what you need to know about it. But before we get into that, let's get started. So Chair Powell, finally, at Jackson Hole, Wyoming, they had their big meeting this past week, and Chair Powell finally said Friday that the Fed's going to lower borrowing costs, looks like as much as next month. He said, the time has come. I mean, this is what we all focus on, quote, the time has come for policy to adjust, end quote. All right, well, is that a clear direction? I think so. I mean, it's about as clear as they get. So we're now thinking that the rates will start to come down. The first one in September, it's highly looking like. Markets loved it, and the Dow was up for the week 1.3%, S&P up 1.4%, NASDAQ, same, up 1.4%. The international index up 1.7, and the 10-year Treasury dropped again this week, down at 3.8. That means that bonds went up. So remember, I've been talking about this for a while. The longer the bond you own, the more upside you get as rates go down. And so this past week, we saw bonds go up another 0.6%. Year-to-date, bonds are up 3.2%. That's just the appreciation on the price of the bond. That has nothing to do with the yield. So if you've been collecting, say, a 5 or 6% coupon, then add on top of that this 3% on the 10-year maturity. And if you've gone longer, remember that exponentially gets bigger as you go out longer on the yield curve. In other words, if you own longer maturity dated bonds, then the more rates drop, the more you make. It's just that simple. It's an inverse function. So that's going on right now. Oil was down this week a little bit, 0.8%, closing at $74.90 a barrel, still well above that $70 price target. So overall, pretty good week for the market. And people are wondering, well, what's going to happen next? When are they going to lower rates, and how much are they going to lower rates? And so that was cleared up a little bit, and that's why the stock market did well, or reasonably well this past week. I don't think that the rate cuts are going to be too dramatic, and here's why. Because I don't think we're looking at any sort of a recession. I don't think the Fed wants to put us into a recession. So barring any unexpected change, say, in the global conflicts going on right now, I expect a 25 basis point cut coming up here in September. And then I think that they're going to continue to cut at 25 to maybe 50 basis points over the next year and a half from there. I mean, remember they said end of 26, they want to be down by at least 2%. So you got some time, and I think it's going to be just slow trudging through it. And again, looking at all the economics, and hopefully nothing breaks out in any of these two wars that are going on right now, and we just sort of maintain this path. I mean, it's never a clear path, right? And if you look at history, whenever there's been a rate cut, in fact, we went back and looked at the last 40 years of when cuts happened and what happened, usually stocks rally. So usually when the Fed does cut rates, and that's why you're seeing the market right now doing pretty well, usually what happens is the market usually goes higher. There's only been a couple times where that's not true a year or 2 years later, and that was 2001, January 2001, and September of 2007. In January of 01, a year later after the Fed had made its first cut, the market was down 12.4%, and 2 years later it was down 30.6%. You may remember that dot-com bust that took about 3 years to fix. And then, of course, the incredible loan crisis that happened in 2007 and 8-9. The first cut we had was September 2007. I do remember that. And a year later, the market was down 18.9. Get this, 2 years later, it was down 26.3. But if you look at 84, you look at 87, 89, 95, 98, 2019, all those, 1 year later, markets were up. 2 years later, up even bigger. So those are good history reflections to look at, and that's why the market right now is optimistic. It's feeling positive. It's saying, hey, well, the Fed's on its way to start cutting rates. Well, guess what? We think things are going to be better. And so that's why the market has been doing so well. And that then brings me to gold and our topic today and what we're going to be talking about, gold. And there are 4 important things you should think about if you're thinking about getting into gold right now. Because after all, when prices do hit new all-time highs, and we did see this, like I said, this past week, we saw $25.48 on a closing price. And that was a big deal. 2,500 was sort of that psychological mark to stay above and close above. And then that happened this past week. We saw a couple times where we got over 25 closing, 2,500 an ounce, right? So that might be too much for you to put in your portfolio in terms of just the cost of it, if you're looking at your overall portfolio and how much you should put into it. So we'll talk about this morning, how do you think about gold? How should you invest in gold right now? If you own it right now, what are some things you might want to consider at this all-time high? If you're looking to diversify your portfolio and you have some time and you're looking at some instability, I mean, all these sort of things, volatile stock markets, how does gold work? How does gold get purchased? How do you store it? How do you own it? I mean, these are all really good questions, and you can thank Jim for asking it because he did. He asked this past week, what do I do about gold? And I said, okay, well, let's get into it. So we're going to talk about that today. We're going to talk about the 4 things you need to think about if you're going to get into gold and what you can do about it. It's all going to be coming up next, so keep it right here. If you have any questions, you want to talk more about this, call me, 866-PROTECT. That number to call is 866-PROTECT. We're live right now. We got people standing by. You're welcome to give us a call, 866-PROTECT. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, and this is Protect Your Assets. And I am known around here as the Sandman. That's because I help you sleep well at night by answering your most troubled tax, legal, or financial questions each week right here. And that's because I've been running a tax, legal, and financial firm for almost 30 years, actually over 30 years. And if you have any questions, this morning Jim asked me a great question. Should I buy gold? After all, it has hit all-time highs. And is now a good time to be buying this? Well, it could be. And so if you've just tuned in, that's what we're talking about today. Should you buy gold? Should you have it in your portfolio? Or might you want to sell it? I mean, all these are really good questions. And for those of you thinking about it, well, we have some suggestions for you. So let's start out with this. This first thing is, should you buy it? Well, let's talk about that. There are two reasons you might want to buy gold right now, even though it did close Friday at $25.48 an ounce. For one, it's difficult when you look to find anything that could replace gold because it is so unique. And so as a commodity and as a unique mineral in the world, it has value just intrinsically because of what it is and the scarcity of it. So if you think that the Fed will continue to cut rates, which now Chair Powell talked about yesterday, then gold typically does better when rates are going down. That's just typically. So study shows that as interest rates and gold prices move in one direction, the other goes in the other. This is just a statistic, which doesn't necessarily mean it's going to continue to happen, but as rates go down, typically the price of gold goes up. Now, as we know, Chair Powell talked about yesterday that he thinks rates are going to be coming down here at their September meeting. I was talking earlier about that being roughly 25 basis points. And as long as inflation continues to cool and the economy continues to chug along, that should be a very relative path. Again, there's uncertainties that can happen. You just don't know. But according to the CME Group FedWatch tool, there's 100%. That's a pretty good statistic, 100% probability of a rate cut of 25 to 50 basis points in September. So again, if that path continues, if the Fed continues to lower rates, then you can expect the price, if you look at history, of gold to continue to move higher. Now, the other big factor that's driving the price of gold up, and this is something that is unknown because it just happens. The last 2 years, there have been records that are broken by what's considered, this is a quote, strong hands. What does that mean? Strong hands is a phrase that's in the commodity industry when you see ultra long-term investors. These are banks typically, central banks in particular, that have the ability to move markets because they control the market. They make policy, and by doing so, they move markets. So central banks are what we call strong hands. And when you have central banks stepping in as large buyers of a commodity, particularly gold in this case, and investing in gold in this case, you have a market start to move a particular direction because they do buy so much of it. Now, we've seen that happen. We've seen as a result of global uncertainty. We've seen a result of China having so much in treasuries and being worried about us not paying them. Because if you think about it, remember what just happened in the Russian war. What did we do with Russia-Ukraine? Well, we went and we seized all their assets, remember? We locked up their ability to get paid back on their debt. What if we did the same thing for China? Big question, right? Big question. So China's sort of hedging its bet. And this way what they're doing is they're saying, well, hey, look, if the U.S. decides not to pay us back on the debt that we've loaned them all this money, well, maybe we'll buy gold. We'll buy a lot of gold, and we'll start having that as a hedge, if you will, a protection against that possibility occurring. So when you see a central bank start to step in and buy in a large quantity, particular commodity, and you can start to see that trend over time, that can have an effect on gold, and that's what's been going on lately. So there you go. So on top of the potential growth that gold has to offer, there's also this risk of a recession or a dip in the stock market to consider. I do see volatility in the market because typically when rates start to drop, you do have markets that do move around a little bit. And let's face it, we have an election coming up in November that's hotly contested right now. We don't know what's going to happen. We don't know what's going to happen with these two global conflicts that are going on around the world right now. So anything could happen. It's a sort of a time of uncertainty. And so gold continues to provide some sort of a protection in that environment because it is a hard asset. Gold is a hedge in your portfolio because it does not move in sync with the stock market. It's just that simple. And so there is evidence out there to support a recession or some sort of a pullback or some sort of a problem for some time. I mean, it just can happen for any of these things that were to fracture or break. Then you're going to have some problems in markets because of the more uncertainty that develops. So remember that does support the price of gold where it is today, and so that's why some people may consider wanting to buy it right now. So again, when there is inflation, when there is the dollar weakening, when you see rates starting to go down, these are all early indications that gold continues to be a strong asset class to have in a portfolio as you consider, your overall investment strategy. The 5-year average, when you look at gold as well, the curve looks pretty good. I mean, if you go look at the how it's done just this particular year, as the heightened concern with inflation and stability has grown, geopolitical tensions grown, as all those factors happen, well, the price of gold rises. And so if you look at it this particular year, it's done fairly well. And you add to that the Ukraine-Gaza uncertainty that's still out there. Well, this drives the price of this commodity higher. So as long as we've got uncertain times, uncertain future, then you're going to have instability, and it is that simple. So those are the factors that you want to look at as you think about owning it. But what about if you already own it and you've had a pretty good run in it? Because again, if you go look at the chart on it, it didn't do real well for a long time, and then all of a sudden, you get this very strong move to the upside, and that's where you start to have to think about, well, what's my strategy here? What am I really trying to do? And that's where you really get into your portfolio and your overall allocation, and what do you need this money for? Because if you're at or near retirement, then there's some things you have to think about. You have to think about if there were a tough time in the market and you needed to consistently generate month after month after month a certain amount of income, $8,000, $9,000, $10,000 a month of income, where is that going to come from? Are you going to be forced to have to sell off some things that maybe you didn't want to sell? Or will the funds be there? Now, gold, like we will talk about, it's a hard asset. So, that asset, sure, you can sell depending on how you own it. We'll get into that. But it's going to have a fixed price depending on, again, the market and what's going on. So if you don't have something that's generating income consistently in a bad market, and now you're forced to sell off your asset at a lower price, so you just lost money. If you bought gold at $25.48 an ounce and the price of that commodity dropped, now you're trying to get out of it. Well, you just may not be the best time for you have to do that. So one of the most important things you can do as you get ready to retire, or if you're in retirement and you're thinking about, say, buying gold right now, is to take a look at your entire portfolio. And so one way that we do that is we use something called a portfolio MRI. I don't know if you've ever heard of this. It's a tool where we can analyze every holding in your portfolio. We can talk about the yield, the cost of owning it, all those sort of things. So you have information to start making decisions. And what you want to do if you're in retirement or you're positioning for retirement is you want to have different buckets that do different things. Think about them like different tools. One is designed to produce income immediately. So if you're going to retire, say, in 6 months, and you want a certain amount of money each month to be hitting your bank account from your investments, from, say, your Social Security, from your rental properties, all these different sources, you should get eyes on that now, and you should be realistic about it. Because let's face it, you might have a nice property. Maybe there's one unit empty. You've been trying to rent it for a long time. It doesn't really work. You know, and I know it's not renting, and you're wondering why. Why is this happening? Why am I not getting rent? But you're counting it anyways. Well, that's not really accurate. You shouldn't do that, because you may have a time for 1, 2, 3 years where it just sits empty. You may have a time where, a tenant decides they don't want to pay you. They're having financial difficulty, so they don't pay you. Now you don't have that rent anymore. So those are things that can disrupt your cash flow. And if your plan doesn't have those built into it, that contingency built into it, you've got a problem. You've got a problem meeting your monthly expectations. And so you don't want that, because that'll force you then to have to sell assets. And if you were retired during 2000 or 2008, you know exactly what I'm talking about. There were times where you couldn't believe you were selling things for the price they were selling for, but hey, that was the market. That's all you could get at that time, and you needed the money, and so you had to do what you had to do. You don't want to be in that position, particularly now when markets are so healthy. Now is a really good time, as I say, to go out and clip some of the fruits of your labors. And so how do you look at that? How would you do that? Particularly gold, if it looks like it's going to continue to go higher, is that really something smart to do? When we come back, we're going to talk about that. We're going to talk about why would you think about selling gold now is now really the best time to be thinking about that. So our next segment, we get into our popular They Say segment, where they say now might be a good time for you to sell gold. Is that really true? Well, you know this saying, I'm sure, if you know Ben Franklin. An ounce of prevention is better than a pound of cure. You are listening to The Sandman on the Protect Your Assets show. We will be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Welcome back to Protect Your Assets. I am David Hollander, also known as the Sandman, and that's because I help you sleep well at night by answering your most troubled tax, legal, and financial questions. And this past week, Jim sent me a question. He said, "Hey, Mr. Sandman, should I be buying gold right now?" And that's because gold's been on a tear lately. And so Jim wanted to know how we should buy it, what form should he take it in, is now a good time to add more? How much should he buy? All these sort of questions. Very, very good questions. Been talking about this morning. If you missed any of our show this morning, particularly the market segment at the top, where we talked about interest rates, we talked about things you need to know with this market, go check out our podcast wherever you listen to your favorite podcast. Just go there, click on the little search hourglass, and type in Protect Your Assets. And then next to it, you could put gold, and it would pop up, and you could listen to everything we've been talking about this morning that maybe you missed, because there are 4 things you should be thinking about if you own it, you're selling it, or you're buying it. You know, what do you need to know? So that's what we're covering this morning. I know it is a good topic, and thanks, Jim, for asking the question. Now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? There's only one man with all the answers, and here he is, David Hollander, the Sandman.
Okay, so here's one they say. They say that now is a great time to sell your gold position, because after all, it's done so well. What do I say? Well, let's get into it, shall we? The bottom line is, if you already own gold, maybe you have a commodity fund, or maybe you outright own the material itself, now might be a great time to capture some of those profits. If you go take a look at just the tear gold's been on this year, you very well could be up over 20%. It really depends on how you did. Now, 20% is nothing to sneeze at. It's a very good profit. And I know there's always a tendency to think, well, it could go higher. It could go higher. Of course it could. But there's also the reality that you've just done pretty well on something very quickly. Because if you look at the growth it's seen, at least in the last 6 months, it's been pretty good. And so there's nothing wrong with taking some profits, especially, this is the asterisk on all this, especially if you need the money. Now, what do I mean by that? You might want to take a look at your cash flow for, say, the next 12 months. Because let's face it, there is uncertainty out right there right now. And if you need that money to live on, it might be a good time to take some chips off the table. Another way to think about it would be if you look at your overall portfolio allocation. We'll talk about this next segment. How much should you own of any particular asset class? Well, let's just say that you had an allocation of gold of 10% in your portfolio. And now if you look at your adjusted percentage, it's now worth, say, 14% of your portfolio, because other things may have gone down. So it would be prudent. We call this clipping the coupons, if you will. You clip 4%. Click 4% off of your holding in gold. bring it back down to your 10% allocation if that's what's appropriate for you. And you leave that in cash possibly. So coming January, February, March, April next year, or taxes coming up, right? You'll have the money to live off of and also pay your tax bill, because we all know taxes are coming. They never end. So particularly on a capital gain, if you've owned this asset for over 1 year, you're looking at a long-term capital gain, which is better than a short-term capital gain, which is the same as your ordinary income rate. Now, if you already own gold right now, what should you be thinking about besides maybe selling some of it? Should you be buying more? This is a really good question. For those who own it, the decision to sell it is, again, guided by your overall investment strategy. What's your financial goal? What are you trying to accomplish? What's your market outlook? All these things are very important. It may be beneficial to take a look at your portfolio right now and see whether or not your current gold holdings align with that objective, because those might have changed. They may be different. And so this is a good time. And your risk tolerance. I mean, most people don't understand how much risk they're taking. And so, like I mentioned previous break, we were talking about that Riskalyze tool, Portfolio MRI. We use that to assess your risk. Think about it like this. If you knew the risk level that you were running, the speed limit, if you were, that you were going, and it was more than you were comfortable with, might you make a change? It's as simple as thinking about you're driving down the road at 150 miles an hour and you're just not comfortable doing that. You're much more comfortable going 65. Well, what do? You take your foot off the accelerator, right? You hit the brake maybe a little bit, not too hard, right? So you do that. Slows you down. You feel better. Well, the same thing is with your money. Maybe you're running at 150 miles per hour right now and you just don't know it. The way to find out is to take a risk assessment. There are tools today. These are very sophisticated tools that use technology to give you that speed limit, to show you you're going 150 miles an hour, and then you can say, I'm going to take the foot off the brake a little bit. How do I do that? Which positions in my portfolio should I start to unload on right now? Very good question. So that's where I ask you, well, how are you owning gold right now? If you're investing in physical gold, what are the benefits of choosing the 1 ounce bar, or coins, if you will, over, say, the bars? How do they compare in price? What about storage requirements? What's the long-term value of it? Accessing all these things. Really good questions. Well, 1 ounce coins, or even the little bars you've seen. I mean, I've seen these ads. You can go look on the internet. You'll see. Be careful, by the way, if you do that. 1 ounce gold bars are often favored for their balance between value and liquidity. They are typically more affordable per ounce than the smaller denominations, like the smaller coins that are under, say, $1. And their size makes them relatively easy to store. In terms of long-term value, 1 ounce bars are widely recognized and easier to sell compared to the larger gold bars you may have seen in the movies, particularly. I was playing the Goldfinger James Bond theme song in our first segment. Yeah, that was wasn't Goldfinger a great movie? Anyway, when you remember in that movie, the gold gun and all that, right? There were these gold bars, and they're so cool to look at. And there's a museum in London where they have gold, and they have the bar you can actually touch. It's pretty cool just to see how much it weighs and what it looks like, and you imagine them melting it down and creating that bar. It's kind of just interesting. And so some people, I know there are people out there, I've seen them, who have gold bars, the big ones, stored in their garage, literally in safes. And I always say, be really careful about who knows about that, obviously. But again, just you may have made that decision where you want to own the actual physical material. So what size, type of physical gold would I recommend to someone out there thinking about investing in gold? Well, the choice of size and the type of the physical gold really depends on your goal, your budget, and most importantly, this is something everyone forgets, storage capacity. Investors who want, again, gold is a hard asset. It's a physical asset. It's like a car. It's like a piece of real estate. If you want that hard asset through a coin or a bar, keep in mind that you're going to have to store it in a very safe place once it's delivered to you. Smaller bars or coins can offer the flexibility in selling pieces of your holding, while the larger bar might be more cost effective per ounce when you look at the commission that you're going to pay when you buy it. It's important to weigh the factors of what I just said against your overall investment strategy and what you're trying to do. So what are some avenues or products you can use to invest in gold? What do I recommend? Well, it really depends on your sophistication when you look at investing in gold. What do I mean by that? If you're a beginning investor, you might consider what's known as an ETF. That's an exchange-traded fund, as they offer you exposure to gold without the complexity of storing it. That is probably one of the biggest things I've seen people make mistakes on all the time, is they buy it and then they think about, well, where am I going to put it? Well, if you go to the safe deposit box, you can only put so much in there before it fills up, and then you got another one, and usually the bank doesn't want to give you another storage box because they have such limited space there anyways. Talk about a hard asset. So now you're forced to store it in your house. And that presents all kinds of issues. Remember the fire up in Santa Rosa? And the temperature of the fire reached over 1,000 degrees. Well, guess what happened to the stuff in the safe? The cash, it burned up. It was gone. The gold, it melted down and changed characteristics and maybe leaked and all that sort of stuff. So now it's not there anymore and you can't get your money. So all these sort of things you have to think about. And on top of that, the commissions. That's right. There are fees to acquire gold and to own it and to trade it. And with an ETF, they're usually pretty standard. Typically 1% is not out of the question. It's typically what it is to buy or sell an ETF out there. And so if you own it in a brokerage account with a custodian that you have faith in, well, that's better than potentially a hard asset retailer. What if you're a more seasoned investor? Well, seasoned investors who own gold, who've owned it, who like it, they might explore a combination of, say, physical gold, ETFs, and here's where we get into gold mining stocks, depending on your overall risk tolerance and investment goals. Those are if you're looking for, say, a safe haven. If you're looking for a safe haven, physical gold, such as coins or bars, could be preferred due to the tangibility and historical value of that asset and the retention that you have by just holding it and being stable. If you hold it, the internet breaks or there's a hack or something bad happens out in the world, well, you have it physically. Now you can use it to go out and buy things, but remember, that's where you might want the smaller coins, because then that's easier to use if that sort of event were to occur. Now, again, that's way out there on the spectrum, but there's folks who think about that and who want to protect themselves. If you're looking for growth, well, if you're focused on growth right now, you might want to take a look at some gold mining stocks or ETFs that invest in a diversified portfolio of gold-related assets. They're out there. There's tons of them. And as always, make sure you always read that prospectus, read all the disclosures, and figure out if that higher potential return is really worth it when you look at your overall portfolio. Now, how much would I recommend you have in your portfolio? How much is too much? Well, when I come back, we're going to talk about that. If you have questions about these sort of things, you want to get help, you want to use our portfolio MRI tool and see what speed limit you're going right now, pick up the phone and talk to a member of my team. We are here right now, ready to answer your call. Call me right now, 866-PROTECT. The lines are open. Oh, I see 2 calls right there. We'll get to you. 866-PROTECT. Call right now, 866-PROTECT. When we come back, we'll talk about how much is too much. What do you need to know? Find out. Keep it right here. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Welcome back to Protect Your Assets. I am David Hollander, also known as the Sandman. People call me the Sandman around here because I help you sleep well at night by answering your most troubled tax, legal, or financial questions. And Jim asked me a question this week, which is, hey, should I be buying gold right now? And if so, he had all these other questions. So we've been going over that this morning. If you missed any of today's show, particularly about gold, if you've been thinking about it, it did hit an all-time high Friday. Over $2,500 an ounce, solid. So will it continue to go up should you buy it? All these questions were answered today. Go listen to the podcast. Protect your assets. Today we've been talking about the 4 things you need to know if you're thinking about investing in gold or if you own gold in your portfolio. And so this last question that Jim asked me is a good one. How much gold do I recommend having in a portfolio? How much is too much? These are really good questions, Jim. So thanks. The appropriate allocation of gold in a portfolio, I think, depends on these factors. First, how old are you? What is your risk tolerance? And what is your overall investment goal? A conservative guideline might be to allocate about 2% of your portfolio to gold. This could be sufficient to give you exposure to the metal, but obviously that could vary. And I always recommend being diversified, particularly when you see a year like this year. I mean, look at the things that have really moved. It's been a pretty good year across the board. But some things like gold have really stood out. And again, let's face it, these are things that for years haven't been doing very much. And then all of a sudden, wham, they just go. And they go strong. And so that's why diversification is a really good idea. But you also don't want to concentrate too heavily in any single asset class. This is where investing gets tricky. And this is where the, let's call it folks without the experience, make a lot of mistakes. They think that something sounds so great, and they go at it in a big way, and the next thing you know, they lose a lot. And so that's why you really got to be careful about this. Now, there are studies out there, you can read about these, where they've said if you have, say, 4 to 5% of your portfolio, that actually helps your overall volatility if you, say, had a 60-40 portfolio. So if you had 60-40, 60% equity, 40% gold, bonds, 60 equity, 40 bonds, which is a traditional moderate allocation that a lot of folks going into retirement think about having. As they get older, they adjust that down more towards fixed income, typically safer. Well, if you added, say, 4% of your portfolio into gold, that can help smooth out volatility because, as I was talking about earlier, gold is a inverse relationship to the stock market. So usually when things are uncertain or markets are not performing so well, gold has tended to provide at least some sort of stability because, again, it's a precious metal. It's a hard asset. It's different than something that's driven by how the company's doing, right? It's just different. So that's why owning any particular percentage, again, really gets into those 3 questions that we started this segment out with and how you would answer those. If you're looking for help on this, maybe you have it, maybe you're wondering how to get out of it, what sort of things you should be thinking about. The best practice is to get clear on what your objective is right now and what you're trying to accomplish when it comes to your income and your stability over the rest of your life. We can help you bring that kind of clarity to your vision right now. If you're feeling uncertain about that, if you don't have clear answers about how much you can spend each and every month and what that looks like over the next 15, 20, 25 years, you're not alone. Get the clarity. Get it right now. Call us because that's what we do. We help you get clear on your vision. 866-PROTECT. Again, the number 866-776-8328. 866-PROTECT. Call us right now. We're standing by. I'd like to give a big thanks to the Protect Your Assets team for putting the Gold Show together today.
I love gold!
My executive producer, Kevin Renfer, network manager, Raf Corral, and, of course, all my fabulous producers back there answering the phone, Phil, Dylan, Adrian, and Lucas. Because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Have a great weekend. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal legal or tax specialist and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.